Welcome back, everyone, to the Noob Selling Options channel. Today's explainer is an absolute must-watch because we are diving headfirst into one of the wildest market paradoxes we've seen all year. I'm talking about the SanDisk Q3 earnings. You know the drill, right? A company posts absolutely flawless, record-breaking numbers, and the stock just tanks. It's incredibly frustrating when you're caught on the wrong side of it. Well, today, we're going to demystify exactly why that happens. We'll use SanDisk as our live case study to map out how market cycles really work, why a stock's price usually peaks way before the actual business does, and, most importantly, how you can actually trade this stuff. Here's a quick roadmap for today. First, the SanDisk earnings paradox. Second, decoding market cycles. Third, the deceleration penalty. Fourth, forecasting SanDisk's fundamental peak. And finally, predicting the actual price peak. Let's get right into it. Starting off with Section 1, the SNDK earnings paradox. Okay, so let's look at April 30th. This was a day that left a lot of retail traders totally confused. SanDisk didn't just beat Wall Street's expectations, they completely blew them out of the water. Wall Street was looking for $4.72 billion in revenue. SanDisk dropped $5.95 billion. That is a massive 251% jump year over year. On the bottom line, adjusted EPS came in at $23.41, nearly a 60% beat. And the internal metrics, just as wild. Their data center revenue jumped 233% sequentially, and they posted massive 78.4% gross margins. By every traditional metric, this was a flawless, absolute blowout quarter fueled by the AI memory supercycle. But here is where it gets crazy. They practically printed money, bringing in almost $3 billion in free cash flow. And what did the stock do? It suddenly dropped over 5% in after-hours trading. No way, right? Why on earth does a company post numbers like that and still get punished by the market?
Well, it all comes down to being priced to perfection. SanDisk had just gone on this historic parabolic run. We're talking a 3,000% surge in just 52 weeks, from $31 all the way past $1,100. It was already up 320% year to date. Add in the whole NASDAQ 100 inclusion on April 20th, and everybody was front-running it. Going into the earnings call, the options market had already priced in a massive 21% implied move. Basically, all this incredible news was entirely baked in. So when there wasn't some massive new catalyst to push expectations even higher, momentum traders just locked in their gains and cashed out at the top.
Which brings us to Section 2, decoding market cycles. If we actually want to trade these events, instead of getting trapped by them, we have to look at the underlying mechanics. Here's the golden rule of finance you have to remember. The stock market is a forward-looking discounting mechanism. It literally doesn't care about what is happening today. It acts like a time machine, pricing a stock based on what the big money thinks will happen 6 to 12 months from now. This is exactly why stock prices peak long before a company's actual revenue hits its ceiling. It generally plays out in 3 distinct steps. Step 1 is the pricing in effect, which is all about anticipation buying. Step 2 is the penalty of deceleration, where valuation multiples start shrinking even if the company is still growing. And step 3 is that classic sell the news profit-taking phase. Once the anticipated maximum growth is actually reported, the smart money just strategically exits. Let's look closer at that second step in Section 3, the deceleration penalty. This is exactly where so many options traders get completely wiped out. They blindly buy calls right before earnings, totally missing the disconnect between what a company's management cares about and what Wall Street actually values. Management loves absolute numbers. They want record profits and massive baseline revenues. But the market is obsessed with the rate of change. Even if a company is making more money than ever before, if their growth rate drops from, say, 200% year over year down to 150%, Wall Street views that as deceleration. And because sky-high valuations demand accelerating growth to justify them, the second that growth slows, those multiples violently contract, dragging the stock price right down with it.
So, after a blockbuster, record-breaking quarter like SanDisk just had, the market basically asks one simple question. Can they possibly do better than this next time? If the answer is no, institutional money just walks away to reallocate their capital into something new that's just starting to accelerate.
Moving right along to Section 4, forecasting SanDisk's fundamental peak.
Let's apply this directly to SanDisk to figure out when their actual business will hit maximum velocity. Enter the law of large numbers. They just posted a 251% revenue increase, right? But next year, they're going to face incredibly difficult year-over-year comparisons because they have to measure against these exact same record-breaking numbers. Maintaining triple-digit percentage growth on a baseline of over $6 billion a quarter is just mathematically unsustainable. It can't last forever.
And this perfectly tracks with the historical hardware cycle. These AI memory supercycles typically run incredibly hot for about 18 to 24 months before supply finally catches up with demand and pricing starts to normalize. If we track the explosive phase of this current cycle starting in late 2025, that puts SanDisk's fundamental operational peak right around Q4 of 2026 to Q1 of 2027.
So, let's tie this all together in Section 5, Predicting the Price Peak.
If the underlying business is expected to peak in early 2027, when does the stock price actually top out? Remember our time machine rule about the forward-looking discounting mechanism? The market usually discounts a fundamental peak roughly 2 quarters in advance. The big funds already know that 200% growth is going to eventually drop to 50% or 30%. Because they are front-running that slowdown, the absolute top for the stock price is highly likely happening right now, anywhere from May 2026 through September or October.
For your options trades, this means the massive, easy buy and hold money has largely already been made. Over the next 3 to 6 months, Wall Street is shifting to a highly tactical, volatility-driven market. This gives us 2 distinct scenarios for the rest of the year. In a bullish volatility scenario, we might see a final blow-off top testing extreme upside near that $1,140 level. But if this recent post-earnings drop was actually the start of a broader sell-the-news distribution phase, we could see a harsh cyclical correction violently testing downside support zones near $400 by early fall.
Which brings me to the most important question for you. Given this timeline and the wild volatility we're probably going to see as the market front-runs this deceleration, are you planning to adjust your current options exposures? Or are you looking to hold steady and tactically trade the swings through the end of the year? Seriously, think about how these forward-looking mechanisms impact your own strategy. If this explainer helped things click for you and you want to keep mastering these mechanics, do me a huge favor. Hit that like button, subscribe to the Noob Selling Options channel, and turn on notifications so you never miss our next deep dive. Thanks for hanging out and learning with me today, and I'll catch you in the next explainer.